Imagine waking up to find your bank account has grown while you slept. Sounds like a dream, right? Well, welcome to the world of income generation through stock market investing. In this first episode of our Income Generation Strategies series, we're diving into one of the most accessible ways to potentially grow your wealth: investing in stocks and index funds. Whether you're looking to supplement your 9-to-5, fund your dreams, or build long-term wealth, this strategy could be your first step towards financial independence. But here's the million-dollar question. How can average people like us tap into the stock market's potential without becoming full-time traders? That's exactly what we'll uncover in the next few minutes. We'll break down how stocks and index funds work, explore their income potential, and provide practical tips to help you get started. By the end of this video, you'll have a clear roadmap to begin your stock market journey. Imagine waking up to find your bank account has grown while you slept. This isn't a fantasy, it's the potential of stock market investing. Whether you're just starting your investment journey or looking to diversify your portfolio, this strategy can help you build wealth with minimal ongoing effort. In this video, we'll break down how stocks and index funds work, explore their income potential, and provide practical tips to help you get started. So, are you ready to unlock the power of passive income through the stock market? Let's start with the basics. When you buy a stock, you're purchasing a small piece of ownership in a company. As that company grows and profits, the value of your shares can increase. Some companies also pay dividends, which are regular payments to shareholders from the company's profits. But investing in individual stocks can be risky. That's where index funds come in. An index fund is a type of investment that tracks a specific market index, such as the S&P 500, which represents 500 of the largest U.S. companies. When you invest in an index fund, you're essentially buying a tiny piece of every company in that index. This provides instant diversification, spreading your risk across multiple companies and sectors. Here's a key difference. When you invest in individual stocks, you're trying to beat the market by picking winning companies. With index funds, you're aiming to match the market's performance. Historically, very few investors or even professional fund managers consistently beat the market over the long term. Both stocks and index funds can generate passive income in two primary ways. First, through capital appreciation. This is when the value of your investments grows over time. For example, if you buy a stock at $50 per share and its price increases to $75, you've gained $25 per share in value. The second way is through dividends. These are regular payments that some companies make to their shareholders, typically quarterly. It's like getting a bonus just for owning a piece of the company. Not all companies pay dividends, but many established firms do, especially in sectors like utilities or consumer goods. With index funds, you can benefit from both of these income streams across a wide range of companies, providing a double opportunity for passive income growth. The beauty of this passive income strategy is that once you've invested, your money works for you. Whether you're sleeping, working, or on vacation, your investments have the potential to grow, creating a truly passive income stream. Now that we understand how stocks and index funds work, let's explore their income potential. Historically, the stock market has averaged about a 10% annual return, though this can vary greatly year to year. Let's put this into perspective with some numbers. If you invest $10,000 and achieve this 10% average annual return, you could potentially earn $1,000 in a year. Now, that's not guaranteed, and it's important to remember that the stock market can be volatile in the short term. But here's where it gets really interesting: the power of compound growth. If you reinvest your earnings and continue to add to your investments over time, your potential returns can grow exponentially. For example, if you invested $500 a month for 20 years, assuming that 10% average annual return, you could potentially end up with over $380,000. That's the power of consistent investing and compound growth. Now let's talk about dividend income. Many established companies pay regular dividends to shareholders. If you invested $10,000 in a stock or fund with a 3% dividend yield, you could receive about $300 per year in dividend income. Remember, these are just examples, and past performance doesn't guarantee future results. But they illustrate the potential for generating passive income through stocks and index funds. While the potential rewards of stock market investing are exciting, it's crucial to understand the challenges you might face. First and foremost is market volatility. Stock prices can fluctuate dramatically, sometimes within a single day. This can be stressful, especially for new investors. The key to overcoming this challenge is to adopt a long-term perspective. Remember, historically, the stock market has grown over time, despite short-term ups and downs. This brings us to our second challenge, the need for patience. Significant returns often require a long-term commitment. It's not about getting rich quick, but about steady growth over time. To address both volatility and the need for patience, consider diversifying your investments across different sectors and asset classes. This can help smooth out the ups and downs. Our third challenge is the risk of losses. There's always a possibility of losing money, especially in the short term. One strategy to mitigate this risk is dollar cost averaging, investing a fixed amount regularly, regardless of market conditions. This approach can help you avoid the pitfall of trying to time the market. Lastly, investing in stocks and funds requires knowledge. Understanding how to evaluate stocks or choose appropriate index funds takes time and education. To overcome this, commit to ongoing financial education. Read books, follow reputable financial news sources, and consider seeking advice from financial professionals. Remember, every investor faces these challenges. The key is to be aware of them, prepare for them, and develop strategies to overcome them. Now that we understand the potential and challenges of stock market investing, let's dive into some practical tips to help you get started. First, start with low-cost index funds. These provide broad market exposure and automatic diversification, making them an excellent choice for beginners. Second, consider using a robo-advisor. These are digital platforms that provide automated, algorithm-driven financial planning services with minimal human supervision. They can help you build and manage a diversified portfolio based on your goals and risk tolerance. Third, implement dollar cost averaging. This means investing a fixed amount regularly, regardless of market conditions. It helps reduce the impact of market volatility on your investments. Fourth, reinvest your dividends. Instead of pocketing the dividend payments, use them to buy more shares. This takes advantage of compound growth, potentially boosting your returns over time. Fifth, educate yourself continuously. The more you understand about investing, the better decisions you'll make. Read books, follow reputable financial news sources, and consider taking online courses about investing. Lastly, be patient. Remember, this is a long-term strategy. Don't be swayed by short-term market fluctuations. Stay the course and give your investments time to grow. Let's look at a real-life example that illustrates the power of index fund investing. In 2007, legendary investor Warren Buffett made a $1 million bet that an S&P 500 index fund would outperform a collection of hedge funds over a 10-year period. By the end of 2017, the results were clear. The index fund had returned 125.8% over the decade, while the hedge funds had gained just 36.3%. To put this in perspective, if you had invested $100,000 in the index fund at the start of this bet, you would have had 225,800 by the end. The same amount in the hedge funds would have grown to only 136,300. Buffett's conclusion: when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. This real-world example demonstrates that even in challenging market conditions, a simple, low-cost index fund can outperform more complex and expensive investment strategies. Now that we've seen the potential of index fund investing in action, let's assess this strategy using our side hustle matrix. This matrix helps us assess the strategy based on 3 criteria: difficulty to start, difficulty to make $100 a month, and difficulty to maintain. For difficulty to start, we rate this strategy at 2 out of 5. With modern investing apps and robo-advisors, it's relatively easy to get started. However, you do need some initial capital and basic financial knowledge. When it comes to difficulty to make $100 a month, we're looking at a 4 out of 5. This can be challenging, especially when you're starting out, as it requires a significant amount of capital. To put it in perspective, to earn $100 a month, you'd need about $12,000 invested, assuming a 10% annual return. Finally, for difficulty to maintain, this strategy scores a low 1 out of 5. Once set up, maintaining your investments requires minimal effort, especially with index funds or robo-advisors. While regular review and rebalancing are recommended, they're not time-consuming. Overall, investing in stocks and index funds offers an accessible entry point with low maintenance, but it does require patience and a substantial investment to generate significant passive income. In conclusion, investing in stocks and index funds can be a powerful way to generate passive income. While it requires some upfront capital and patience, it offers the potential for long-term wealth building with minimal ongoing effort. Now it's time for you to take action. Here's what I want you to do. 1. Research low-cost index funds or robo-advisors. 2. Start with a small regular investment you can comfortably afford. 3. Commit to educating yourself about investing. Remember, the best time to start investing was yesterday. The second best time is now.